Hi, everyone. Thanks for joining us today. This is Allison Dwyer with CQG, and it's my pleasure to introduce Bill Glenn, who will be providing an overview on trading with oscillators. If you have any questions during the webinar, please enter them into the Q&A window, and we'll answer them at the end of the presentation. Without further ado, I will turn it over to Mr. Glenn.
Hi, everybody. It's been a while since I've done a webinar, probably a good 3 years. So if I'm a little rusty, I apologize, but I'll try to make this relatively painless, and maybe we can all learn something and open up some discussion. So CQG and I've been a partner of CQG for quite some time. I've used their product for over 10 years. I think it's a great firm, and every once in a while I like to give back a little bit and kind of talk about things that I use in my daily life, things that I've learned, things I'm still working on. And one of them was, there's so many different oscillators out there. Maybe we can actually kind of decode some of them and figure out what might be best for what kind of situations and what you might want to use. So who am I? I started in the business in 1997 for Salomon Brothers. I've really always been a fixed income trader. I worked on their funding desk on the fixed income floor, their repo desk as it's known. We merged with Citigroup, Smith Barney in '99. I've always really traded treasuries. I started at the very front end. I traded short coupons and twos. I moved out into the 5-year sector, did a lot of RV. Somewhere along in the lines in there, I realized the value of understanding price activity and capital flow and technical analysis. I added it to my toolbox, so to speak, somewhere around 05, 06. I've been a pretty intensive user ever since. I moved to TD to start up a primary dealer in 09. During that time, I was a contributor to a book written by a gentleman by the name of John Netto. It's called The Global Macro Edge. Not often we can say we contributed to a book. It's a great book on global markets and what value a lot of different traders can bring to it. I wrote a chapter. It's probably the one you want to read if you want to go to sleep, because it talks about the backbone of the fixed income markets and kind of what it is to work at a bank and a funding desk. From there, I moved to Seeloss & Company here in New Jersey, and some things about me: I like technical analysis, a bit of a VBA code hack, and I got an old Jeep I like to work on. All right, quick disclaimer, just have to throw this out there. This is the whole thing's for educational information purposes. I'm not telling you to buy anything, not sell anything, not take any risk out there in the markets. If you do, there's a very, very good chance you might lose money. But just want to throw that out there. All this stuff's educational. So oscillators. I'm going to talk about the kind of the three main ones that everybody talks about to kind of start off the bat. RSI, MACD, Stochastics, two slightly lesser known, and one's a little bit more momentum driven, which is the ADX and DMI. The CCI Commodity Channel Index is one I picked up along my travels. Finally, the one that I use the most now, which is the ATM Trigger, which was developed by Rick Knox and Advanced Trading Methods. So what do we use oscillators for? Typically, we're going to use them for overbought and oversold situations. Everybody likes to talk about, okay, what's the RSI? It's overbought. We need to sell it. It's oversold. The RSI is at 2, or the MACD is very oversold. It's very extended. We should be getting long. That's one way you can use them. Typically, that's not how I use them, and I'm going to show you how I do. But that's kind of how the broader market likes to use them. They can quantify trend. Eventually, we like to use them for some sort of buy or sell signal. And I think the most powerful way to use them, and how I've really always used them, is divergences. All right, relative strength index, developed by Wells Wilder. I'm not going to go into how this thing's calculated. There's a ton of information on the internet if you want to go look for it. Basically, it's an oscillator that goes between 0 and 100. It's looking for average gains and losses over n-bar periods. If it's a 9-bar RSI, you're looking back 9 bars. You're looking for average gains and losses over that time period. And then you're creating this factor, this relative strength index, and you're subtracting it. You're adding it and dividing it from 100, and you get this bit of an oscillator. We're looking for overbought and oversold. I like to use it for divergences. It's a great divergence indicator. It's very clean. And one thing that's interesting I learned from Tom Hartle, who also works at CQG, a very value-added individual, is that the RSI is actually the difference of, follow me here for a second, the close versus the value of a simple moving average 2 times the value of your RSI. So basically, you're tracking the difference. The RSI is giving you a visual representation of the distance, and I don't have it on here. I probably should have thrown it on here, but this is a 9-bar RSI. I should have put an 18-bar moving average on here. If you did, and you can do this in your own time, and you just take an eyeball and kind of spot it, you can look at the close versus that moving average, and that's about where you're going to get the RSI value. So off the bat, what do we see here? We've got overbought and oversold levels. Overbought's above 70 or 80, whatever you'd like to use. Below 20 or 25 is oversold. That's one piece of the puzzle. I like to use them as a bit of a momentum divergence. So if you think about what you're looking at, all technical indicators are really looking at current price activity versus previous price activity. And this is going to go for Stochastic and MACD and CCI. You know, we're looking back 9 bars, and we're looking at average up and down of each one of these bars, and then we're factoring it to find some sort of relative value or measurement that we can look visually to say, okay, are we overbought or oversold? I like to look at these divergences. So here you can see, and this just happens to be Apple I used here, put in a close middle of October with an RSI value up around 80. We chopped around. We put one more push in higher in this kind of, you know, this big, strong 2-day push. But if you notice, the RSI indicator could not get back up to the same level it was before. To me, that's a momentum divergence or a price divergence. So what you're looking at is basically the close of this bar versus where the it had been previously over the last 9 days. It didn't have as much strength. So you look for some exhaustion. That kind of, you know, throws the ears up, the antenna go up, and you say, okay, something's probably coming. And this happened to be a great example. Obviously, Apple sold on pretty aggressively in the beginning of November. And then we had a bullish divergence. And really all I'm looking at here is, and I don't use the low of the bar because that's not what you use to calculate RSI. If you're going to use an indicator, you have to understand what it's using. This RSI is using close. So I'm comparing the close of these bars, and I'm looking at the divergence of RSI couldn't make a lower low, price did. That's a bullish divergence. You know, pay attention. This goes from a C trade to a B trade to an A trade where you're watching it looking for new price development. And you can go from there and start to look at, you know, buy indicators off of this low. Now, how I like to look at RSI, and this is also something that Tom Hartle passed along to me, is that I like to put it as a histogram. So I'm going to look at it versus the 50 line. And if price is above that N-bar moving average, so price is above it, what would be a 22-bar simple moving average here versus the RSI of 11. You know, above the line, price is above the moving average. You're trending higher. So this is RSI gives you a very, very basic indication of trend. When price here is moved below that moving average, you're below the 50 line. And your average down bars are more powerful than your average up bars, and you're trending bearish. So it's a decent, very, very basic indicator of trend. And obviously with CQG, you can color the bars, you can write your own code. That's a whole nother webinar I'd be happy to do sometime, but I really like to kind of nitty-gritty get inside there. I colored these bars green if I've got a bullish trend, red if I've got a bearish trend. I like to make things very simple. Last but not least, I like to use kind of moving average retraces, so to speak. This isn't an actual moving average retrace, but it's an RSI value coming down towards 0, which means price at the end of the day is returning to this average that we have of the RSI, and then it starts to trade up higher again. So you've got, you know, green bars or, you know, prices above the moving average is trending higher, and the RSI dips back down towards the 50 line and then starts to move higher again. So when we start to come back down towards the 50 line, we've got some sort of upward trend in here. I'm going to then look for the RSI to trade higher. You know, there's books written on this, and you could spend years on it, but then, you know, you kind of figure out where you want to put your stop, and you can manage your trade against this buy signal. All right, that's basically RSI. I'm going to go then into MACD and Stochastics. MACD, you know, basically you're looking at 2 different moving averages. Again, it's a momentum indicator a bit. It's going to tell you when you're bullish and bearish. It's got 3 components: the MACD line, the signal line, and the histogram. The MACD line is the difference between 2 moving averages. So the MACD by itself is going to tell you a lot about price activity in one compact indicator. It's the difference between you can use exponential, simple, whatever you like. Personally, I'll use exponential moving averages. Standard is kind of a 9-bar and a 26 bar. Some people use a 6 and a 12. I like to use things that are relative to the type of markets that you trade and the speed in which you trade. Once again, it's another webinar to talk about what time periods you should be using. But basically, you've then got the signal line, which is just that's a smoothed MACD line, and then you've got the histogram, which is the difference between these two. All right. This is it. I put the two moving averages up on top so you can kind of get a feel for what they look like. This orange bar is going to be your MACD line. That's the difference between those two moving averages, and you can kind of see it, right? You can see how it mimics the difference between this your fast and slow moving average. Your signal line is the smoothed MACD line, so we're just smoothing that by 3 bars, 8 bars, 9 bars, whatever you get comfortable with. Obviously, a slower moving average like a 9 or a 12 bar is going to give you less signals. It's going to be a little bit slower. A faster moving average like a 3 or a 5 or a 9 bar is just going to give you more signals. So as long as you have an idea of what you're looking at and the time frame in which you're trading, you can mess around with these averages. I put a 522 simply because there's 22 trading days in a month and there's 5 days in a week. So that's kind of what I chose. Again, the histogram then is the difference between the MACD line and the signal line. So that's kind of telling us when momentum is slowing. So the histogram is going to change based upon the difference between these two lines. Again, I like to use the histogram for divergences, a lot like the RSI. Here happened to be a great change right here. Good opportunity to get in. Obviously, all trades need to be managed with stops and risk and capital budgets, but decent buy signal there. You can also trade the MACD line crossing the 0. And like I said, all this stuff is on the internet. I found personally, for my own work, I like to quantify trend some way. I like to get the histogram above 0. I like to get the MACD line or the signal line above 0. And then I'm looking for places to buy pullbacks. Here you've got a situation where the signal line above 0, you're trending higher. Histogram trades down below the 0 line, which means you have a compression between these two averages and a compression between the slowed line and the MACD signal line. And then you could buy this move higher. So with this one indicator, you can quantify trend using the MACD line and the signal line, and then you can use the histogram for compressions in price activity and expansion. And that's really what we're looking for. We're looking for the market to compress and then take a trade and looking for it to expand. All right, stochastics, developed in the 50s. It's been around for a very long time. It's a nice clean oscillator, but it has a little bit of a range component in it, where MACD is just the difference between two moving averages. RSI is the different averages of highs and lows versus a previous level. This is taking your current close minus your lowest close, and then it has this highest high minus lowest low. So it's really taking into account a bit of a range. So the stochastic is using a bit of a range over N bars, and it's kind of telling you where you are versus that range. A little bit different than MACD and RSI. I like to use stochastics, again, for divergences. I'll use a slow and a fast stochastic for turning points, but I think it's also got its drawbacks. It can get very choppy. As far as overbought and oversold are concerned, I think it does a good job. Here you can see where you've got a bit of a divergence from relatively decent time period too, almost 12 days, 12 to 13 days, a bit of a bearish divergence, you got a bullish divergence, and these are the same kinds of signals. I've used the same chart for all of these. I used Apple between this October and November period of last year for RSI, MACD, stochastics, and you can see they're telling you about the same kind of stuff. Now, the stochastic does a nice job of telling you when you're oversold down here. It's down below the 0 line, get a bullish divergence. So we know that these oscillators are telling us basically the same things. You have to find one that works for you and the time frame that works for you, and then you need to be consistent, because then you can start to keep a log, see how these things trade, and follow them. The CCI, this was developed by Donald Lambert. To me, it's a faster oscillator. I like to use it intraday. It will vary. It's not bounded by 0 and 100 or minus 100 and 100, though the way he designed it, 70 to 80% of the price activity will be between 100 and minus 100. So it's your typical oscillator. Now, I use the CCI with not only a slow but a fast. So I use a 14-day CCI, and then I put a 5 or 7-day CCI on top of that. And I'm looking for, once again, the CCI above 0, which is giving me a bit of a trend, and then I'm looking for pullbacks, or I'm looking for dips in this faster commodity channel index. Developing trend, and I'm looking for dips to buy in that trend. You can already kind of tell I'm not a big fade trader. I'd much rather find a trend and get on that trend. I think that's a much better way to trade. The market does only trend 25 to 35% of the time. The rest of the time we're in a choppy market. If you can quantify that, you've got half the market figured out. What I'll do is typically try to look for the market reversing, and I have a bunch of different measures. You can use different types of oscillators. This one, obviously you can see it turns green. That's the CCI trading back above 0, and then coming back down to the 0 line, holding a value, and then starting to move higher again. So this is indicative of a trend, and the red boxes, which I've circled along the way here, are different buying opportunities you might have had along the way. ADX, momentum indicator, also developed by Wells Wilder. It's been around for over almost 40 years now. This was a little bit different. It doesn't oscillate between 0 and 100. The ADX itself is ambiguous to bullish or bearish. It has two components to it, which it does break out, the DMI plus and the DMI minus, the directional movement index up and down. It will give you a direction of trend. The ADX itself, though, is really just looking at average true range above and below the previous two bars, and then it's accumulating that and telling you whether you have a momentum move higher. I'm sorry, you're either expanding in range or you're contracting in range, or you're increasing or decreasing in momentum. So what I've done here, Apple again, November into December. So we're really not looking for divergences here. We're looking for momentum. So this could be something you could use with one of your other oscillators. We've picked direction of trend. Obviously, price started to move down here. This red triangle is when the positive crossed below the negative directional movement index. The orange line here is that momentum. It's an absolute value, so it's basically rising when you have increasing momentum. This happens to be to the downside. We had momentum to the downside. That's indicative of the red directional movement index on top. You can go to Investopedia or stock charts or a billion places on the internet to look up the actual calculations for these if you want to become more comfortable with it. But what I like to use it for is momentum in the direction of a trend. And as soon as that momentum starts to shift, right, we've got the ADX here above 50 or close to 50, pretty strong momentum. This gray histogram I coded myself. This is the change of the ADX bar, the orange bar. As soon as that starts to turn down, and I've had a decent run, and a decent run could be quantified by many different things, 1 or 2 or 3 standard deviation moves, whatever you want to look at for different markets. Everything's going to be a little bit different. When that momentum indicator turns down, I really start to pay attention to the trade that I'm in, or I'm paying attention for what could be a new trend. We have a reversal in the market. Trend starts to die back down again. This green arrow here is indicative of the DMI plus moving above the DMI negative. Momentum's rising. Maybe that's a trade we should be taking. We should be looking at it. If the momentum is rising, DMI is positive, maybe we drop down to a real short oscillator. Maybe we use a 5-bar, 7-bar RSI, or a 7 or 9-bar commodity channel index. You're looking for pullbacks in that trend. I'm sure there's some buy signals up in here. I don't have the oscillator on here at this point in time, but you could throw, you know, something else to use with the ADX. I don't typically use the ADX by itself. I typically use it with another oscillator. Last but not least, what I wanted to talk about today, I don't want to waste too much time, the ATM Trigger, developed by Rick Knox. It has 3 different timing models in one indicator. It's composed of the fast trigger, the slow trigger, and what's called the trend strength bar. It is non-configurable, so it's not like RSI MACD. You can't change the numbers. It calibrates itself to price activity. It looks for trends and uses timing along with price to produce buy and sell signals or give you indicative or indications of trend. It's available on CQG, and you can also find it on atmstudies.com. I like to obviously give credit where credit is due. This is what the ATM looks like. It has a bit of an oscillator feel with the fast and slow trigger. The fast obviously moves back up and down here. The slow trigger it kind of rides in the background. It's your second most strongest indicator of trend, and then the trend strength bar. This will stay bullish or bearish for quite a long time, or you'll see that it can transition from bullish to bearish. What we're doing here is this is an indicator that kind of changed the way I look at the market, and the reason I wanted to add it was because it's so powerful for me. You really want to look for direction of trend. I started looking for directions of trend. I started using pullback buy signals. The ATM was a little bit different because it has a bit of a timing component to it, where it won't stay overbought or oversold completely. It will have this forced time oscillation to it. Even though you have what I would call a pronounced narrow trend here, you still get oversold buy, even though not as powerful. You have these buy and sell signals. The red lines are sell signals off the fast trigger. The green and the blue arrows are either add-on or fast trigger buys. So this is an indicator that gives you a little bit more of the trend and signal buy and sell signals than maybe some of the other ones. The other ones you have to learn and really spend some more time to adapt them to your own trading. Now, so just to recap, and I've gone through a lot of information very quickly. I apologize for that, but you can go back through this recording if you need to once it's available. You know, oscillators are telling us where we are right now versus previous activity. That's all they're telling us. It's not a holy grail. You know, every time an RSI is overbought, it's not time to sell. Every time it's oversold, it's not time to buy. Every time you see a MACD signal cross up, is that a buy signal? Maybe, maybe not. You have to take these oscillators, find one that works for you, and follow it. Make it part of your routine, chart it, keep track of it, and see how it can add value to the way in which you take risk. If it's useful, keep it, stay consistent. If not, pitch it out and try something else. So what are the big drawbacks? And this is my biggest problem with things like MACD, Stochastic, and RSI, was that when you get a compressed trend move in the market, you'll notice that because you're looking at price versus a prior price, and because you're always looking at this N-bar look back, if you get a long pronounced narrow trend, as we did in Apple out of February, you almost notice that MACD just kind of dies out. There's no real signals here. You've got a bullish trend, the signal line's falling, the average line is falling. The histogram's really telling you nothing because both of these averages are almost right on top of each other. RSI, same type of thing. You're overbought and you stay overbought. There's really no great buy signals. It's really not telling you anything other than we're in a bullish trend and it's rallying. Stochastic, same thing. Look at this. It became overbought back in January and it stayed overbought for a very, very, very long time. And it just then became oversold in April. So you have to realize what these stochastics are telling you. They're not a holy grail. Understand the way in which they're making their calculations, and then try to find them when look for trades that work, but as much look for trades that don't work. That really changed the way I trade and how I take risk. Looking for trades that don't work is just as important as looking for trades that work. And this is one of the drawbacks. If you sold Apple back here when the stochastic became overbought and it turned down its first time here, you were really upset. And obviously, when you trade equities, it comes down to, and this is with a rule of thumb, because I'm not an equity guy. Remember, I'm a fixed income guy. It comes down to the fundamentals. And I think that's always important for an investor. All right, I've talked nonstop for 30 minutes. Any questions? I'd love to take a few questions. I can go back in here. I have a couple other charts that I added after this, which we can go over. But please let me open this up for any questions.
I'm not seeing any questions come in right now. Let's wait a few moments. If anyone has any, go ahead and put them in the Q&A.
Mark, you mentioned a slowdown. Where can I go back to and talk a little bit more about? Might have lost him.
Yeah, that's okay. Okay, there is one on how do you know you are starting a trend versus a trend range?
How do we know we're starting a trend? That's really one of the hardest things to figure out. What I like to do to find new trends is first use the ADX. I like an ADX which is rising. Let's go back to ADX real quick. ATM. All right, the ADX. So when you might be starting a new trend, the ADX is going to start to rise from a lower level, and that means you're kind of coming out of a compression. The ADX is telling you your positive and negative movement above and below previous bars. So as that ADX value starts to rise, you know you're possibly starting a new trend. Now, whether you're breaking out of a range or not is very difficult. You look at previous highs, obviously. You can start to look at this ADX started to rise from here. We've got a positive DMI above negative, and we took out a prior high. That's probably a new trend. I typically, like I said, I'm not a fade trader, so I won't sell this previous high unless I've got a whole bunch of stuff telling me that we're up against big resistance and, you know, you're exhausted. But here, obviously, given that momentum was from a relatively low level and starting to move higher, it's probably indicative of a new trend. And I won't just look at one stock by itself. I'll look at an overall index. If I'm trading 5-year notes, I'm going to look at 10-year notes also. The ATM has an excellent indicative trend indicator. So the trend strength bar, it was locked bearish here for a very, very short period of time, and it began to transition higher. When it locks into this bullish position and the slow trigger is also above, call it the 70 line, 65 or 70, you've got a pretty good shot, I'd say 60 to 70% chance that you're in a new trend, and I'm going to be looking for buy signals. I'm definitely not going to be selling this market. So oscillators many times can not only give you buy and sell signals, but it can keep you from trading. I won't ever trade against the fast trigger on the ATM. So when this fast trigger is rising, as it is here, I'm not getting short. There's no reason for me to be short. And when the trend strength bar is locked bullish, that's 2 reasons not to be short. So really what I'm doing is I'm taking or removing a side of the market. I'm removing the short side of the market. I'm not even thinking about it. I'm only looking for places to buy this market, even though we've come all the way out of the low, right? Went from 105 to 115. You're still looking for places to be long because the price activity has told you that you're in a bullish trend. So I'll use ADX, I'll use ATM, and that's how I'll really try to quantify trend. Once that's in place, then I'm really just looking for buy signals.
Okay, another question. Do you use the ATM by itself?
I will use ATM by itself. I do a lot of analysis on top of my oscillator work, which I just did for this presentation, but I use a lot of capital flow work. So I'll look at Pete Stoudemire's market profile. Inside of that, I'm looking for support and resistance levels. I'm looking at development of the market. I've added volume to a lot of my work over the last couple of years. I've learned a great deal from Market Delta, and I use that in combination with ATM. So what I'll do is I'll find or characterize the market, bullish or bearish, and then I'm going to try to find places or low-risk places to buy or be long and low-risk places to be short. So I'll use it in conjunction with other things. I'm not sure there's any one indicator I will use by itself.
Okay, another question on the MACD hist. I've played around with different bar numbers. Some work better for commodities and other for equities. Do you have a suggestion for different products?
That's a great question. When I first started using technical analysis, I back tested everything. I went to school as an electrical engineer, so I've got this quant side to me, and I really wanted to kind of test everything I possibly could. I settled on a 534 for a long time. This MACD right here is a 534.7, and that happened to be fast enough for me because I'm a little bit of an impatient trader. It's probably one of my drawbacks. So I get impatient sometimes. I like the faster moving averages, but the 34 smooths it out, so it kind of keeps it relatively clean. I will tell you that looking at a lot of different markets, I've charted fixed income, I've charted currencies, I've charted equities, I've charted spreads, oil, commodities. Everything has its own characteristics. It has its own life, its own way of trading. I would tell you to keep trying different timing indicators for different markets, but I would also tell you that you should probably be using more than one time frame. A big change that I made to the way I trade is I added multiple time frames. Rick got me doing this. Also Stan Yabroff from CQG, he got me to, many years ago. He said, "Why are you only looking at the daily? You really have to, you have to take a look at how you trade, how you like to take risk, and then use a time frame which fits that. If you're going to be in a trade in the morning, get out at lunchtime, get back in at 2 o'clock and be out by the close, you almost have no business looking at a daily chart. You're using a 5-minute chart into an hourly for something like that, and then an hourly into a daily. So I'm looking, in a perfect world, let's say I'm trading oil. I'm looking for a daily chart, maybe with a bullish trend, or my oscillators are moving up. I'm dropping down to the 60-minute. I'm looking for the 60-minute to get a bullish signal or do something right, and then I'm looking for buy signals on the 5-minute or the 15-minute or the 10-minute. And sometimes these much shorter time frames can be very dangerous to trade because they're much noisier. The intermediate time frames give you a bit of a flow to the market, so I kind of use them all together. But I hope that helped to answer it. Every market's a little bit different. I would start to figure out how fast you want to trade and then adjust those settings based upon that. And MACD is a great one to mess around. I would keep my first moving average somewhere between 5 and 7. The middle of that moving average somewhere between 22 and 34. Any longer than that, you're just slowing down too much. And then your slowing line, the average you don't see on there, somewhere between probably 5 and 11.
Okay, and here's another question for you. What other indicators have you used, and have you found just these to best suit your needs?
I've tried almost every indicator I've ever seen. I've used volatility adjusted indicators. As far as oscillators are concerned, these are the main oscillators that I've used. I started with RSI, moved into Stochastics, kind of threw those two out. I like RSI. I think it's a relatively clean one. And then I got into MACD, and then I started coding a whole bunch of my own stuff that's here. This is basically a CCI with a slower one on it. It's a slow commodity channel index with a fast one behind it. I use that for intraday charts. I like that. I used to trade 5-minute into 15-minute all day long with that until I kind of started to slow things down and move out and use the ATM for slightly longer time frames. The top one here is an RSI, and then I put a %R on top of it, and a %R is just a super fast RSI. You can look it up. I've tried a lot of different things. I've used the parabolic SAR. I've used stochastics. I've used trend lines. I've used pitchforks. I think all of them have different things they tell you about the market. Price activity is very complex. At the end of the day, we're trying to find out who the participants are in the market and what they're doing. There's large participants. There's many different time frames of participants. There's portfolio accounts that make adjustments once a month to quarterly. There are swing traders that take positions every 2 to 5 to 7 days. And then there's intraday scalpers or day traders that might take 3 or 4 or 5 positions a day, and then there's scalpers that might take 500, just trying to pick up a few cents here and a few cents there. If you can try to figure out what market participant you think is most important to the time frame in which you trade, then look for indicators that you think will tell you when those people are active in the market. And that kind of goes back to time frame. I think time frame is extremely important. Personally, I know that the ATM, when the fast trigger swings from low to high, it takes on average 7 to 9 bars. Rick will tell you it's about 8.5 to 8.7 bars. So if I want to hold a trade from here to here and I want to get out, and I don't care, this is a S&P weekly, I don't care if it's a weekly, it's a daily, it's a 5-minute or 10-minute. I've got to probably hold it for somewhere between 6 to 9 bars. If it's a 10-minute chart, I've got to be comfortable holding that risk for 60 to 90 minutes. If it's an hourly chart, I got to hold it from 6 to 9 hours. So that's why I said before, if you're going to take 2 or 3 trades in a day and you're looking at a daily chart, you're tripping over yourself trying to decode something that's extremely hard to decode. You really need to be dropping down, looking at lower time frames and using them in conjunction with other ones. If an hourly chart is going to swing or trend for 6 to 7 hours, great, perfect. As that starts to move higher, you know you probably have 5 to 6 hours on your side. Then you're going to drop down. If you like to hold risk for anywhere between 30 and 60 minutes, you're using a 5-minute or a 10-minute. And there's nothing wrong with that. One thing I learned when I was a macro trader, and then I was an RV trader, and then I started messing around with technical analysis and how it could help me get into my macro trades better at a better time. You could have the greatest idea in the world about a stock or a fixed income asset or oil, but if your timing is wrong, it doesn't matter. Your idea might have been right, but it blew up anyway. Look at long-term capital. All those trades came to convergence. They all converged. They would have been right, but they ran out of capital. Capital is not unlimited. And because of that, your time is not unlimited in a trade. And you want to be able to manage that. And that's what technical analysis helps us do. So I think time frame is extremely important. That's probably the biggest indicator that I've learned how to use properly. And then I like to use ATM, cap flow, and then I'll use ADX, MACD, and CCI for probably different types of markets. I hope that answers your question. There's just so many different things that I've tried over the years.
Bill, it looks like we have one more question. What is your view of using Renko versus time-based bars?
Ooh, that's a good question. What type of bar?
R-E-N-K-O.
Oh, Renko bar, sure.
Yes.
I messed around with, spent some time on constant volume bars. I've used Renko bars. I've used point and figure. I think, once again, you have to try to figure out what you're trying to get out of the market. Are you trying to track volume? Are you trying to track capital flow? Then probably constant volume bars are good for you. If you're trying to take time out of it, then yes, Renko bars, point and figure. Point and figures, it's been around forever. And I just started using it and really tinkering around with it about a year ago. Someone got me on it. It has a great value when you're looking for price moving out of range. I would tell you that you should be aware of what those bar patterns are doing that are not dependent upon time. I think that's really good, especially in the overnight sessions. A market can sit very, very, very quietly overnight and do nothing. Though maybe there was a decent amount of volume, but the range was very tight. You don't want to have 16 bars on a time-based chart when you really should probably only have 1 or 2. Because the range hasn't moved, the volume hasn't been enough to really compare it to something intraday. So what I'll do is I'll look at overnight bars, from a couple of different ways. Renko, like you said, is a great way to look at the market. I like CVB bars also, and sometimes I'll throw a point and figure on there just to get an idea of what the ranges looked like. You know, did we actually break outside of any sort of like, you know, 5-tick, 7-tick range? If not, then you see a nice consolidated period and you're looking for something new to happen during the day. If there was a lot of news overnight and you established a whole bunch of point and figure or Renko bars, then you know something was obviously going on in the overnight session, and you can take that into the daytime session or the opening range. So yeah, I've used different types of bars. I think they all have value. Each one tells you something different about the market. So it's good to have a couple of different things to add into your daily routine to help you quantify what sort of market you're in. Was it a quiet overnight? Was it a busy overnight? Was it a large range? Was it a small range? And what could you anticipate for today based upon yesterday's range and the overnight range?
Here's another question for you. Do you use any order flow tools?
All right, we're going way off topic here. I do really like order flow tools. Again, talk to Tom Hartle or Stan or any one of the specialists at CQG. They can help you out with it. I can't pull up my live CQG because we're not really allowed to give advice here. But order flow bars, to me, are the footprint that drives all price activity. Prices move and the market moves because you've got an information flow. Something happened. How many times were you sitting on a desk or looking at a chart or sitting there and all of a sudden the market moves? Prices move, bang, higher, lower, something changed, and then you look at your newswire and you go, oh, what just happened? It happened first in the chart. It happened first in the order flow. I've written a bunch of stuff. I've taken trade flow volume and created my own on-balance volume indicators so I can look at what the on-balance volume has done for the accumulated session, what it did overnight, what it's done during the day, obviously going during the day. A lot of people like to use VWAP. I don't think it's as important in fixed income, though some people tell me it is. It's not a tool I like to use. It's hugely important in stocks because I think it's something that people that are active in the market use. You know, some of this stuff is a self-fulfilling prophecy. You know, if you've got an order flow desk, or not an order flow desk, but if you have a programmatic desk at some firm, XYZ, and they've got to buy 1 million shares of BBB or whatever stock it is, you know, treetrunks.com, and they're watching the VWAP, then the VWAP's important because they're creating the market for that stock. They're driving that stock. And if you're not paying attention to it, then you're not actually paying attention to the market. So when I look at order flow, I'm looking at accumulation throughout the day. I'm looking at large prints. I'm looking at the way that volume has, you know, is it a big volume day but we've gone nowhere? Is it a low volume day, but we've had a big move? Those relationships are important. You can go back to look and see how the stock has traded or the commodity or the currency has traded on large volumes with small ranges, large volumes with big ranges. And you can start to figure out what the characteristics of that chart are and learn more about that actual, that instrument. So I do like order flow a lot. I use a lot of on-balance volume. I use a lot of trade flow, net buying and selling, so I can kind of see when someone's coming into the market. Is the market responding? You know, there's a lot of work out there with trend lines, and I'm not going to tell you that I'm the expert on trend lines. I'm not the expert on a lot of different things, but I'm aware of them, and if you've got good support and resistance levels that you find that you like to use, some people like pivots, some people like modified pivots, volatility-based adjustments off the open, off the prior day's close. They use range expansion indicators. In combination with those, I will look to see what the volume is doing when you come back to those levels. So when you're coming up against a resistance point, is volume decreasing? Is the market slowing down? I'll drop to a lower time frame. Do we actually get volume to just, does the buying stop, right? Does the trade flow buying stop when you come up to 123 the buck in the 10-year contract? Does it, you know, does the selling stop when we come back down to 122.16? If it does, then that level means something. because the market participants are telling you it means something. All these lines, all these moving averages, they're all looking back in time. The only thing that is right now is volume. And that volume, that cap flow is telling you what is happening in the market right now. So you can have all these great moving averages, you can have all these great support and resistance levels, but until you see what the actual larger market participants are doing when you come to those levels, you're flying blind. So yeah, I use order flow a lot. And we could do another webinar on that if you want. Let me know, give some feedback to Allison, and we could spend an hour talking about trade flow and cap flow.
Well, it looks like we don't have any more questions, so I want to thank everyone for joining us today and thank you, Bill, for presenting. If anyone missed anything during today's webinar, you can review a recording on CQG's YouTube page, which will go up shortly. And if you have any follow-up questions, please feel free to reach out to Mr. Glenn or your CQG representative.
Thanks so much.
All right, thanks, everyone.